Washington never saw it coming, and now American automakers are scrambling, stock markets are dropping, and the cost of cars is about to skyrocket. But here's the real shocker. This is only the beginning. For decades, the United States dominated North American trade. Until today, Canada just blindsided the auto industry with a strategic economic strike, hitting America where it hurts most. What happens next could change everything, from car prices to the entire economy, the move no one saw coming. In an unprecedented counterstrike, Canada has imposed a massive 25% tariff on steel and aluminum exports to the United States, coupled with an additional 10% surcharge on energy exports. These materials are the backbone of automobile manufacturing, and this decision is sending shockwaves through an industry already struggling with supply chain issues and economic uncertainty. For American automakers, the effects were immediate. Stock prices for Ford, General Motors, and Tesla took a nosedive within hours of the announcement, signaling investor panic over rising production costs. Factories that have long depended on Canadian material now find themselves scrambling for alternatives. But the reality is that there are no easy substitutes. Canada provides a substantial percentage of the steel and aluminum used in American car manufacturing, and replacing it would require either turning to more expensive suppliers or cutting production entirely. Beyond the automakers, the broader economic impact is just beginning to unfold. With energy prices already fluctuating due to global instability, the additional 10% surcharge on Canadian energy exports means that manufacturing costs will rise even further, affecting not just cars, but also industries that rely on heavy machinery, construction materials, and consumer goods. The economic burden of these increased costs will ultimately be passed down to consumers, who will soon find themselves paying significantly more for new vehicles. But what if Canada isn't just fighting back, but breaking free from United States dependence entirely? Breaking free. While the United States has assumed that Canada would always remain its largest trade partner, the reality is that Canada has been preparing to reduce its reliance on American trade for quite some time. This decision to impose tariffs is not just about striking back at unfair trade policies. It is a signal that Canada is ready to stand on its own. Over the past decade, Canada has steadily diversified its trade agreements, strengthening economic ties with Europe, China, and other Asian markets. The Comprehensive Economic and Trade Agreement with the European Union, for example, has given Canadian industries a foothold in one of the world's largest markets, reducing their dependence on the United States. The shift is also happening at home. The Buy Canadian movement is gaining momentum, first in the food and agriculture sectors, and now expanding into manufacturing and retail. Canadian consumers, frustrated with economic policies that seem to prioritize American interests over their own, are actively choosing domestically produced goods over imported alternatives. Grocery stores, shopping malls, and major retail chains are prominently labeling Canadian-made products, encouraging consumers to keep their money within the country. And it is working. Canadian businesses are seeing increased demand for locally sourced goods, while United States brands are beginning to lose their foothold in the Canadian market. This shift in consumer habits is not just a short-term trend, it is a long-term transformation that could permanently alter trade dynamics between the two nations. The result? A potential economic divorce between Canada and the United States, with Canada moving toward a more independent trade strategy that reduces its vulnerability to American policies. If this shift continues, the United States could find itself increasingly isolated, losing one of its most reliable economic partners. And while Canada plans for the future, Washington is in full-blown panic mode, Washington's crisis mode. Behind closed doors, United States lawmakers are scrambling, but will they make things better or worse? The sudden and severe impact of Canada's tariffs has sent Washington into crisis mode, with political leaders urgently debating how to respond. The truth is, Washington completely underestimated Canada's willingness to fight back. For years, the United States has implemented aggressive trade policies under the assumption that Canada would remain a passive partner, willing to absorb the financial damage in order to maintain economic stability. That assumption has now been shattered, and the political fallout is immediate. Emergency meetings have been called within the White House, with advisors presenting two starkly different options: retaliate with even harsher tariffs or negotiate a diplomatic resolution. But there is no clear consensus. Some lawmakers are calling for an even stronger stance against Canada, arguing that backing down would make the United States look weak. Others warn that escalating the trade war will only worsen the economic damage, particularly for American workers who are already struggling with inflation and job instability. The stakes are particularly high in the context of the 2024 presidential election. With economic issues dominating voter concerns, the administration's handling of this crisis could determine political futures. If manufacturing jobs are lost and prices continue to rise, the ruling party risks losing crucial support in key battleground states like Michigan, Ohio, and Pennsylvania, where the auto industry plays a central role in the economy. Meanwhile, pressure is mounting from corporate executives. Leaders from Ford, General Motors, and Tesla have already begun lobbying lawmakers, warning that continued economic uncertainty could force them to shift production to other countries or cut jobs in the United States. The auto industry is too important to the national economy for Washington to ignore, but the path forward is unclear. And while politicians debate, the real crisis is already hitting the people who can least afford it: American workers, the first victims. Factory shutdowns, layoffs, skyrocketing costs. The auto industry is bracing for impact, and the first to suffer are the workers who keep it running. With rising production costs, automakers are slashing jobs in an attempt to offset financial losses. Assembly line workers, metal fabricators, and suppliers are finding themselves suddenly out of work as companies scramble to restructure their operations. And it is not just the auto industry. The ripple effect is spreading across industries dependent on steel, aluminum, and energy, putting thousands more jobs at risk. Steelworkers in the Midwest are already feeling the impact as demand for materials fluctuates unpredictably. Energy sector employees, particularly those involved in refining and transporting fuel, are seeing their industry thrown into uncertainty. As companies try to absorb higher costs, the economic shockwave is extending to small businesses as well, as rising prices force suppliers and contractors to increase their rates or cut back on operations altogether. For the average American, the consequences of this trade war are unavoidable. The cost of cars is about to surge as manufacturers pass increased production expenses on to consumers. Financing a new vehicle will become more expensive, lease agreements will rise, and even the used car market will feel the impact as demand skyrockets for affordable alternatives. And this is just the beginning. If tensions continue to escalate, the auto industry could face a long-term crisis that reshapes the entire market, pushing American-made vehicles further out of reach for everyday consumers. But here is the real nightmare. This crisis isn't just about gas-powered cars. The electric vehicle industry is about to take a massive hit. The electric car nightmare. Governments invested billions in subsidies, automakers shifted production strategy, and consumers were told that the era of gas-powered cars was coming to an end. But now an unexpected crisis threatens to bring that future to a halt. Canada, one of the world's leading suppliers of critical materials for electric vehicle batteries, has imposed trade restrictions that could cripple the industry. Lithium, nickel, and aluminum are essential components in the production of electric vehicle batteries. Without these materials, companies like Tesla, Ford, and General Motors face catastrophic supply shortages that could drastically limit production. The problem is not just higher costs. It is a fundamental disruption of the supply chain. Automakers have spent years fine-tuning their logistics, ensuring that essential materials arrive on time to maintain efficiency. Now, with sudden restrictions on imports from Canada, these companies are left scrambling for alternatives. The consequences are already being felt. Tesla, which relies heavily on Canadian nickel for its high-performance batteries, is facing skyrocketing costs. Ford and General Motors, both of which have invested billions into electric vehicle development, are suddenly being forced to reconsider their production timelines. These shortages could delay new vehicle rollouts and force manufacturers to shift their supply chains to less reliable sources. While American automakers struggle, China is seizing the opportunity to dominate the electric vehicle market. As the world's largest producer of electric vehicle batteries, China has been aggressively expanding its control over global resources. With Canada limiting exports to the United States, China is moving in to secure long-term agreements for nickel and lithium, giving its domestic automakers an even greater advantage. If this trend continues, American manufacturers could fall behind permanently. allowing China to establish itself as the undisputed leader in electric vehicle production. But this crisis is not just about the future of electric vehicles. The impact of rising costs and supply chain disruptions is rippling through the entire auto industry, creating a nightmare scenario for both companies and consumers. And it is not just electric cars. The entire United States auto industry is at risk of collapse. The death of affordable cars. For years, the cost of new vehicles has been steadily rising, but the latest trade war between Canada and the United States is about to push prices to an all-time high. Automakers can no longer absorb the rising costs of raw materials, and those costs will soon be passed on to consumers. What was once an industry that offered a range of affordable vehicles is now heading toward an era of luxury-only pricing. Steel and aluminum tariffs alone are increasing production costs by thousands of dollars per vehicle. With lithium and nickel prices soaring due to trade restrictions, electric vehicles are becoming even more expensive to manufacture. Automakers are left with only two choices: cut production or pass the costs on to consumers. The result is a market where everyday drivers will struggle to afford even the most basic vehicles. Used car prices are also set to surge. With new cars becoming more expensive, demand for pre-owned vehicles will skyrocket. This is not speculation. It is already happening. Over the past several years, supply chain disruptions have led to record-high used car prices. Now, with further restrictions on manufacturing, those prices are expected to climb even higher. Consumers who hope to find relief in the used car market may find themselves paying more than ever before. The hidden effects of this crisis go beyond sticker prices. Leasing options, which have been a go-to strategy for consumers looking to drive new cars at lower monthly payments, will become less attractive. Automakers struggling to maintain profitability will likely reduce incentives and increase interest rates on financing plans. The impact will be felt across the entire industry, as shrinking consumer choices force more people to delay purchasing a vehicle altogether. The biggest concern is that this trend is unlikely to reverse anytime soon. Automakers are locked into a cycle of rising costs, and without a major policy shift, prices will continue to climb. The dream of affordable car ownership, once a cornerstone of American culture, is quickly fading. And just as the auto industry struggles, another major United States economic pillar is starting to shake: energy. The energy crisis no one expected. Imagine waking up to gasoline prices surging overnight, home energy bills doubling, and inflation spiraling out of control. This is not a hypothetical scenario. It is already beginning to happen. The United States has long depended on Canada for crude oil, natural gas, and electricity. But now, with new trade restrictions in place, that energy lifeline is in jeopardy. Canada is one of the largest exporters of crude oil to the United States, providing millions of barrels each day. Natural gas flows from Canadian pipelines to heat homes in the northern states during brutal winters. Hydroelectric power from Ontario and Quebec keeps the lights on in major American cities. If Canada follows through on further restrictions, the effects could be devastating. The most immediate consequence will be soaring gasoline prices. The moment supply becomes restricted, fuel costs will surge. For an economy already dealing with inflation, this could push everyday expenses to unbearable levels. Heating costs are also at risk of skyrocketing, particularly in states that rely on Canadian natural gas. Households that were already struggling with energy bills may face a crisis this winter. The timing of this crisis could not be worse. With global energy markets already unstable, Canada's move adds another layer of uncertainty. American industries that rely on stable energy prices, from manufacturing to agriculture, will see production costs rise, leading to higher prices on consumer goods. If Canada further reduces energy exports, the United States may be forced to seek alternative suppliers, many of whom charge significantly higher rates. This would create an even greater economic burden on American businesses and consumers, leading to a downward spiral of rising costs across multiple industries. But Canada is not the only country rethinking its economic ties with America. Mexico is now facing a billion-dollar decision. Mexico's big decision. Mexico's auto industry is deeply intertwined with both of its North American neighbors. Vehicles assembled in Mexico often contain Canadian raw materials and American components. This makes the country uniquely vulnerable to the trade war between Canada and the United States. If Mexico sides with Canada, it could accelerate the decline of American manufacturing. If it remains aligned with the United States, it could risk losing access to crucial Canadian resources. The domino effect of Mexico's decision is massive. If Mexico strengthens its economic ties with Canada, American automakers may lose a crucial production hub. This could lead to even greater disruptions in supply chains, further driving up vehicle prices and manufacturing costs. On the other hand, if Mexico chooses to remain closely tied to the United States, it may face backlash from Canada in the form of reduced trade partnerships. With global markets watching closely, Mexico's next move could redefine the economic landscape of North America. As American and Canadian leaders scramble for leverage, Mexico holds a powerful position. If it shifts away from the United States, it could permanently alter the balance of power in the auto industry and beyond. And while the United States fights to hold on to its allies, another superpower is making moves in the background: China. China's power play. The United States has relied on Canada for critical raw materials like nickel, lithium, and aluminum, the essential building blocks of modern technology, for years. These metals power everything from smartphones to electric vehicles, making them some of the most valuable resources on the planet. But with trade relations between Canada and the United States reaching a breaking point, Canada is now exploring new trade deals, and China is first in line. Chinese officials have been aggressively negotiating with Canada's mining sector, offering lucrative contracts and long-term agreements that could permanently redirect the flow of these resources away from the United States. If these deals go through, it would be a catastrophic shift for American automakers, who are already struggling to secure affordable materials for their vehicles. The biggest concern is that China doesn't just want access to Canada's resources, it wants to dominate the entire global supply chain. Over the past decade, China has been rapidly expanding its control over lithium and nickel mining operations worldwide, securing deals in South America, Africa, and Australia. If China successfully locks in exclusive Canadian contracts, it could gain a near monopoly on the global battery supply chain, putting the United States at a serious disadvantage in the race for electric vehicle production. And the timing couldn't be worse. American automakers like Tesla, General Motors, and Ford are already struggling with rising costs and logistical nightmares caused by the trade war. If their access to Canadian raw materials is cut off, they will be forced to pay higher prices for lower quality materials from other countries, or worse, buy directly from China. The long-term risk is clear. China could replace the United States as North America's primary supplier of critical materials, giving them unprecedented leverage over the entire auto industry. And if that happens, the economic consequences will be felt far beyond the car market. But if the United States thought this crisis was just about auto manufacturing, they're about to get hit with an even bigger shock: the inflation explosion. From groceries to gas, this trade war is hitting every American's wallet. At first, the battle between Canada and the United States seemed like an issue that only affected automakers, steel manufacturers, and government officials. But now, as the fallout spreads, it's becoming clearer than ever. This is an economic disaster that could hit every single American. The reason is simple: inflation is about to skyrocket. When the cost of production increases, businesses have only two options: absorb the losses or pass them on to consumers. And in today's economic climate, most businesses are choosing the latter. Auto manufacturers, already facing crippling tariffs on steel, aluminum, and energy imports, are raising prices on new vehicles. But that's just the beginning. The ripple effect of these price hikes is spreading across industries, affecting everything from appliances and home construction to groceries and fuel. When the cost of raw materials goes up, everything that depends on those materials becomes more expensive. Farmers, who rely on tractors, harvesters, and other machinery made from steel and aluminum, are now paying significantly more for equipment, which means higher food prices at the grocery store. Manufacturers of household appliances, electronics, and tools are struggling with rising material costs, leading to more expensive consumer goods. Even gas prices are on the rise, as Canada's energy tariffs make it costlier to import oil and electricity to the United States. And with the economy in freefall, Wall Street is already making its move. Wall Street's reaction: smart investors saw this coming, and now they're shifting billions of dollars overnight. While the general public is just beginning to feel the effects of the trade war, the financial elite have been quietly repositioning their investments for months, preparing for what could be the most significant economic shift in decades. Auto stocks are crashing. The moment Canada announced its retaliatory tariffs, shares of Ford, General Motors, and Tesla plummeted. Investors know that higher production costs mean lower profit margins, and with supply chain disruptions piling up, many fear that some automakers won't survive the crisis at all. Hedge funds and global investors aren't waiting around to see what happens. They're pulling their money out of American automakers and redirecting it towards safer bets. Some are investing in European and Asian car manufacturers, which are now poised to gain market share as the United States struggles with tariffs and production delays. Others are moving into commodities, betting that the prices of steel, aluminum, and energy will continue to rise as the crisis deepens. But it's not just automakers and commodities that are seeing shifts. Some industries are actually profiting from the chaos. Renewable energy companies, for example, are attracting massive investment as countries look for alternatives to fossil fuels. Shipping and logistics firms are also benefiting as manufacturers scramble to find new supply chain routes outside of North America. For the average investor, this turmoil presents both risks and opportunities. Some sectors will collapse under the weight of higher costs and trade restrictions, while others will thrive as new global alliances emerge. But even if Wall Street survives, the real question is, what happens to the everyday American? The great economic shift. The world is changing, but is the United States ready for its new reality? For decades, the United States has been the dominant economic power, setting the rules of global trade and shaping international markets. But this crisis is exposing a harsh truth. The world no longer depends on the United States the way it once did. Canada is already forging new trade relationships with China and Europe, reducing its reliance on the United States. Mexico, caught in the middle of this dispute, is considering shifting more of its trade to Canada and China instead of the United States. Even longtime American allies in Asia and Europe are watching this trade war unfold and reassessing their economic ties with Washington. If the crisis continues, the United States may find itself permanently weakened in global trade. A weaker dollar, higher import costs, and fewer strategic alliances could reshape the economy for decades. The trade war could accelerate the rise of competing powers, with China stepping in to fill the void left by a fractured North American market. And if that happens, the consequences will extend far beyond car prices and Wall Street losses. The United States could enter an era of economic decline, where it no longer sets the global agenda, but instead struggles to keep up with emerging superpowers. And with everything on the line, the final showdown is about to begin. The last chance. Can the United States prevent an economic collapse? Washington now faces an impossible decision: negotiate or escalate. The first option, negotiation, means admitting that the current trade strategy has backfired. For the administration, that is a tough pill to swallow. A reversal of tariffs and economic sanctions could stabilize the auto industry and bring relief to both manufacturers and consumers. But politically, it would be seen as a sign of weakness. It would mean conceding to Canada's demands and acknowledging that the economic pressure has hurt the United States more than it helped. Some policymakers argue that this is the only viable path forward, urging the government to seek common ground before irreversible damage is done. They propose a new trade agreement that would restore economic balance and prevent further escalation, but the window for such a deal is closing fast. The second option, escalation, is a gamble that could lead to total collapse. If Washington doubles down on tariffs and trade restrictions, the consequences will be devastating. Automakers, already struggling under the weight of higher costs, could be forced to move production overseas, cutting tens of thousands of American jobs. Inflation will surge as industries reliant on Canadian materials scramble for alternatives, driving up the prices of everything from cars to household goods. The energy sector, already on edge, could see a supply crisis that sends fuel prices soaring, impacting millions of Americans. The global pressure on the United States to resolve the crisis is mounting. International allies are warning that prolonged trade disruptions will have ripple effects on the broader economy. Canada has strengthened its partnerships with Europe and Asia, and if the United States fails to act, it risks being left behind. Mexico, a crucial player in North American trade, is now considering realigning with Canada, a move that would further isolate Washington. The world is watching, waiting to see whether the United States will choose to de-escalate or push itself deeper into economic turmoil. So what do you think? Will the US find a way out, or is this the beginning of the end for American auto dominance? What do you think? Will the US bounce back, or is a new era of trade taking over? Drop a comment below.